guys, welcome back to another week of Mortgage Matters in Minutes. Again, I'm your host, Brent Rasmussen, owner of Mortgage Specialists. Today, we're going to chat about how to purchase or buy a home in your early 20s. And that question is coming up nearly each and every day. How can I get into a home when I'm younger and just getting started in my career, my family, whatever the scenario may be? And I will chat with you. It's getting more challenging as prices of everything have gone up, but there still is a way. And with a plan, we can always obtain homeownership, which, as we have seen the last few years, homeownership values have increased every year and continually increased by large sums of money, mainly because we don't have enough properties out there for everybody that wants one. So if we can start making a plan or even start purchasing in our 20s, that value of that home is going to increase, just like investments on your retirement account, your 401ks, your Roth IRAs, other investments that you may have. So let's get started today and let's chat and figure out how we can, in our early 20s, get into a house. I think the very first thing that we need to establish, especially if we're in our early 20s, is our credit and establishing a credit account, because you're going to have some credit history to show to underwriting and to prove that you have the ability to make a payment. Sometimes that is much more challenging to start credit as a younger individual, but as long as you have income, you're able to open up a credit account. It doesn't have to be large, it's just getting something started. And so sometimes opening a credit card might just be as little as a $300 credit limit. Or you might need to open up a secured credit card, which means giving the bank or lender $300 worth of cash, and they give you $300 worth of credit. What I can share with you is credit is vital and it's important to your life moving forward. Not only do lenders for autos, house, student loans, credit cards look at your credit score, insurance now is using a score formula that's based how pricing for your insurance is going to happen compared to your credit score. You can also build some credit called non-traditional, meaning paying your rent on time, insurance on time, any bills that you may have on time. I know some credit accounts, Equifax, TransUnion, Experian, allow you to post that information to your credit to show that you've had credit and you're building credit and you're paying things on time. Another simple way that might work is to obtain a gas card on your parents' account as an authorized user, just to show on your credit that you have history. You need time. 12 months generally to 24 months generally is the time that you want to have credit in order to apply for a mortgage loan. And here in the state of Nebraska, 19 is the age of majority. You can start obtaining and owning credit accounts at the age of 19. So when we're 20 or 21, can we qualify to purchase a home? Heck yeah, there's enough time there available to make things happen. Number two is documenting a 2-year work history. And I use the 2-year history very lenient because most people think that you have to be at the same job for 2 years or the same title of job or the same company for 2 years. And that's not all true. We need to see a 2-year work history. Part-time can be some of that. They would like to see obviously full-time, but also schooling and educational schooling, whether that be a 2-year degree, a 4-year degree, whether that's in a particular trade. They'll allow that to count towards your 2-year work history. But what we're going to want to do to qualify you is look at what your income is. And your income can generally only afford so much of a payment. And that's what we call debt to income ratio. We've done a lot of videos on debt to income ratio that you could check out. But we want to first start documenting income to show that we have that available with that 2-year time frame and history. So again, you start a job at 19, by 21, you would be ready to go and ready to qualify. Third, I think one of the biggest things is saving money. You can never save enough money. If you ask any investment advisor, they'll always share that when they have had a client get ready to pass away or anything else like that or retire, basically would they ask them, hey, did you have enough money to do what you want to do in life? And no one ever says they had too much money. So the same thing goes for planning to buy a home. You can never have enough cash or assets available to do whatever you want with. And the more you have, the more available you have. But there's two reasons why we're asking you to save money. One is if you can religiously save the same amount every single month, whether it's $200, $500, $1,000, $2,000, the higher the number, the better. We can show to underwriting, hey, look, this particular borrower has saved this much money every single month. And it shows the underwriter, look, they have the ability to save this much month to make this future mortgage payment and qualify. So in the meantime, you might do $1,000 a month for 12 months. That shows, look, I've made this house payment of $1,000 a month. And at the end of it, you have $12,000 saved. That is enough now for a down payment to get you into a property, into a home. It also shows the underwriter that you don't have what's called payment shock, meaning once you do obtain that home payment, you're not going to be, worried or not have the ability to make that payment. You'll have the cash and you'll have the proof that, look, I've set aside this money to make things happen. How do you know how much money you need to save per month? That's exactly where someone like us can come in to help you establish a budget. And not necessarily do we have to go do line by line on your budget, but we can definitely show you, hey, for this price of a home, here's what a payment would look like. And here would the down payment be. So you can start making that plan. If you want a $200,000 house, a 3 or 4 or 5, how much money you might need for cash to close and what the payment might look like. Because I can assure you, most of the clients that we've chatted with over the last 2 years, as rates have went up and home values have went up, people aren't expecting the numbers to be so high, and they generally don't have enough money saved for what they need. But if you can start your credit early, if you can go ahead and get your work history going early, if you can save money per month for that mortgage payment, save for a down payment, you can purchase your home in the early 20s and be off to the races. With home values continually increasing, you're going to gain equity. And by your early 30s, you'll be purchasing your second home with much even larger down payment. I hope you can check us out each and every week here on our Mortgage Specialist YouTube channel for our series called Mortgage Matters in Minutes. We're here to help educate and guide anyone that's interested in housing, whether you're a first-time buyer, a move-up, or an investor. Again, you can contact us anytime at 402-991-5153 or check us out on our website at mtg-specialist.com. Have a great rest of your week. We'll see you all next time. Mortgage Specialists. Driven, trusted, reliable.